Welcome to our in-depth guide on mastering real estate market cycles. Whether you're a seasoned investor or just getting started, understanding these cycles is crucial for making smart investment decisions. In this video, we'll cover everything you need to know about market cycles, timing your investments, and advanced strategies to ensure long-term success. We'll begin with the basics. What is a real estate market cycle? A market cycle is the natural progression that real estate markets go through over time, typically consisting of 4 phases: recovery, expansion, hypersupply, and recession. Let's break these down. 1. Recovery. After a downturn, the market begins to stabilize. Property values and rents are low, making this an ideal time for savvy investors to buy at discounted prices. 2. Expansion. The market grows, demand increases, and property values rise. This is when the market gains momentum, and there's often an opportunity to ride the wave of appreciation. 3. Hypersupply. Supply starts to outpace demand, and the market cools off. Prices may still rise, but at a slower pace, signaling that it might be time to consider selling. 4. Recession. The market contracts, prices drop, and vacancies rise. This phase can present buying opportunities for those prepared to invest during downturns. To navigate these phases, it's essential to monitor key economic indicators. Here are some to watch closely. 1. Interest rates. Low interest rates can fuel demand, driving up prices, while rising rates can cool the market. 2. Employment levels. High employment usually means more people can afford homes, driving demand. Conversely, rising unemployment can signal a downturn. 3. GDP growth. A growing economy typically boosts real estate demand, while a contracting economy can lead to a slowdown. 4. Housing inventory levels. The number of available homes can indicate whether the market is heading toward hypersupply or contraction. Timing is everything in real estate. Let's talk about when to buy and when to sell. 1. Buying in the recovery phase. Prices are low, and the market is just starting to recover. This is often the best time to purchase properties at a discount, positioning yourself for significant gains during the expansion phase. 2. Buying in early expansion. As the market begins to grow, buying early allows you to benefit from rising prices. Identifying the early signs of expansion, such as increasing sales and development activity, can help you make well-timed investments. 3. Selling in late expansion. As the market reaches its peak, it may be wise to start selling. Watch for signs like slowing price growth and increasing inventory, which suggests the market might be cooling. 4. Selling in the hypersupply phase. When supply outpaces demand, prices stabilize or begin to decline. This is a key time to sell before a potential downturn. Let's dive into some advanced strategies that go beyond just understanding market cycles. 1. Combining market cycle analysis with fundamental analysis. Look at underlying factors like local economic conditions, employment rates, and infrastructure developments. Combining this with market cycle analysis helps you make informed investment decisions. 2. Leveraging market trends. Urbanization, technological advancements, and demographic shifts offer additional insights. Spotting these trends early can help you identify high-growth areas and maximize returns. 3. Using technical analysis. While more common in stock trading, technical analysis can also be applied to real estate. Analyzing price charts, volume data, and moving averages can help predict market movements and refine your investment strategy. 4. Risk management. Advanced investors know that managing risk is crucial. Strategies like portfolio diversification, hedging, and leveraging can protect your investments through different market phases. We'll explore some real-world examples of investors who successfully navigated market cycles. These case studies will highlight what they did right, the challenges they faced, and how you can apply these lessons to your own investments. Understanding and mastering real estate market cycles is essential for any investor looking to succeed in this field. By timing your investments, combining market cycle knowledge with advanced strategies, and learning from real-world examples, you can build a resilient and profitable real estate portfolio. Remember, real estate investing is a journey. Stay informed, stay patient, and stay strategic. sure to check out my next video.
When it comes to real estate investing, one of the best ways to begin is by starting small. Whether it's a single-family home or a small multifamily unit, these manageable investments allow you to learn the ropes without overwhelming risk. Smaller properties require less capital and provide valuable learning opportunities. From tenant management to cash flow understanding, starting small helps you build confidence and experience. You'll learn to navigate maintenance, rent collection, and property value appreciation at a pace you can handle. You'll also gain insight into crucial aspects like property management and repairs, skills that will become invaluable as you scale up your portfolio. Starting with smaller properties lets you focus on generating steady cash flow without the burden of a massive mortgage. It's easier to calculate your return on investment and figure out what works for you. Plus, it's easier to manage risk. Smaller investments mean smaller losses if something doesn't go according to plan. It's all about minimizing risks while maximizing learning. As you gain experience and confidence, you can gradually scale up. Maybe your next step is acquiring a second property or even a larger multifamily unit. The key is to start small, stay consistent, and grow sustainably. While single-family homes and small multifamily units are great starting points for real estate investing, they come with their own set of challenges. Understanding and preparing for these challenges is key to your long-term success. One of the biggest challenges you'll face is managing tenant relationships. Even with a small number of units, issues can arise, from late rent payments to maintenance requests. Establishing clear communication channels and setting expectations from the start can help mitigate these challenges. Consider using property management software to keep everything organized and ensure that you're responsive to tenant needs. If managing tenants directly isn't your preference, hiring a property management company can help take some of the burdens off your shoulders, though it will impact your overall returns. Real estate markets can be unpredictable, and fluctuations can impact your rental income and property values. It's important to be aware of the broader economic factors that influence the real estate market, such as interest rates, employment trends, and local economic conditions. Building a financial cushion for unexpected vacancies or maintenance issues is crucial for weathering market downturns. Additionally, regularly reviewing your portfolio and market conditions can help you make informed decisions, such as when to raise rents or sell a property. Securing financing and managing cash flow are ongoing challenges, especially when you're starting out. Understanding your financing options, whether it's traditional mortgages, FHA loans, or leveraging home equity, is essential for making informed investment decisions. Additionally, keeping a close eye on your cash flow is critical. Ensure that you're not over-leveraging yourself and that you have reserves in place for unexpected expenses. Proper financial management is the backbone of successful real estate investing. Once you've decided to start with single-family homes or small multifamily units, it's important to focus on strategies that can maximize your returns. By implementing smart tactics, you can increase your income and build long-term wealth. The location of your property is one of the most critical factors in determining your success. Look for areas with strong rental demand, good schools, and access to amenities like public transportation, shopping, and parks. Properties in these locations tend to attract reliable tenants who are willing to pay a premium for convenience and quality of life. Additionally, areas with positive growth trends are more likely to see property values appreciate over time, further enhancing your investment returns. Maximizing returns isn't just about buying the right property, it's also about what you do with it. Look for value-add opportunities that can increase your rental income or property value. This might include renovations that enhance the property's appeal, such as updated kitchens and bathrooms, or adding amenities like in-unit laundry or outdoor spaces. Even small upgrades can make a big difference in how much rent you can charge or how quickly your property appreciates. Consider also the potential for converting single-family homes into multifamily units if zoning laws allow, as this can significantly increase your rental income. Consider implementing long-term rental strategies that align with your investment goals. For example, offering longer lease terms can provide more stability and reduce turnover costs. Alternatively, you might explore short-term rentals if the market supports it, which can generate higher income but requires more active management. Understanding your market and aligning your rental strategy with local demand will help you maximize returns on your investment. When you're just starting out in real estate investing, single-family homes and small multifamily units are excellent entry points. They offer a manageable way to begin building your portfolio without overwhelming you with complexity. Single-family homes and small multifamily units generally have lower purchase prices compared to larger properties, making them more accessible to new investors. These types of properties also typically require less upfront capital and are easier to finance, especially if you're just starting out. Additionally, they often come with lower operating costs, which means fewer surprises in terms of maintenance and repairs. This makes them a practical choice for those looking to gain experience without taking on too much risk. One of the main advantages of single-family homes and small multifamily units is their simplicity in management. With fewer tenants and less complex property operations, you can manage these properties more easily, even if you're working a full-time job or have other commitments. You'll also find it easier to find tenants, as these properties appeal to a broad market, from young professionals and small families to retirees. This simplicity allows you to learn the ropes of real estate investing without getting overwhelmed by the intricacies of larger properties. Starting with single-family homes or small multifamily units gives you a solid foundation to build on. With lower barriers to entry and simpler management requirements, these properties are an ideal way to gain experience, build equity, and prepare for more complex investments in the future. Leverage returns. While leveraging debt can significantly enhance your buying power, it's essential to use it strategically. Let's explore some key strategies for maximizing the benefits of mortgage loans in real estate. Not all mortgage loans are created equal, and choosing the right one is critical to your success. Fixed-rate mortgages offer stability with consistent payments, making them ideal for long-term investments. Adjustable-rate mortgages, ARMs, may start with lower rates, but they can increase over time, which introduces risk. Understanding the pros and cons of each type of mortgage and selecting one that aligns with your investment strategy is crucial. For instance, an ARM might be suitable if you plan to sell or refinance before the rate adjusts, while a fixed-rate mortgage might be better for a long-term hold. Your debt-to-income (DTI) ratio is a critical factor in securing favorable loan terms and managing your leverage effectively. A lower DTI ratio suggests a healthy balance between your income and your debt, making it easier to qualify for additional financing. To optimize your DTI, focus on increasing your income, perhaps through rental properties and managing your existing debts. Keeping your DTI below 36% is generally recommended to ensure financial flexibility and reduce risk. Leverage is not just about buying a single property. It's a tool to scale your entire portfolio. By strategically refinancing properties as their values increase, you can pull out equity to reinvest in additional properties. This strategy allows you to continually grow your portfolio without needing substantial new capital. However, it's important to be cautious and not over-leverage, which can expose you to significant risk during market downturns. Strategically using debt can be a powerful way to grow your real estate portfolio. By choosing the right mortgage, optimizing your DTI ratio, and using leverage to scale, you can maximize your buying power and build a robust, diversified investment portfolio. Leveraging mortgage loans to invest in real estate can be highly rewarding, but it also comes with risks. Understanding both the risks and rewards is crucial to making informed investment decisions. As discussed earlier, the primary reward of leveraging is the ability to control more assets with less of your own capital, leading to potentially higher returns. In addition to property appreciation, rental income can provide a steady cash flow that covers your mortgage payments and even generates profit. Moreover, real estate is often considered a hedge against inflation, meaning that as prices rise, your property value and rental income may also increase, further enhancing your returns. Leveraging also allows you to diversify your portfolio, reducing the risk associated with any single property. While the rewards can be significant, leveraging debt also introduces risks. The most obvious risk is the obligation to repay the loan, regardless of how your investment performs. If the property value decreases or if you experience extended vacancies, you could struggle to meet your mortgage payments, leading to financial strain or even foreclosure. Additionally, rising interest rates can increase your borrowing costs, particularly if you have an adjustable rate mortgage. Market fluctuations, economic downturns, and unexpected expenses can all impact your ability to manage leveraged properties effectively. To mitigate these risks, it's essential to conduct thorough due diligence before purchasing a property. This includes understanding the local market, evaluating potential rental income, and forecasting long-term trends. Keeping a conservative approach to borrowing, such as limiting your loan-to-value (LTV) ratio, can also help manage risk. Lastly, always have an exit strategy in place, whether it's selling the property, refinancing, or paying down the mortgage early, to ensure you can adapt to changing market conditions. Leveraging mortgage loans in real estate offers significant rewards but comes with inherent risks. By understanding and carefully managing these risks, you can harness the power of leverage to build wealth and achieve financial success in real estate. When it comes to buying property, cash leverage work for you. Welcome to our series on real estate investing. Today, we're kicking things off by talking about two key strategies: cash flow and appreciation. Whether you're just starting out or looking to expand your portfolio, understanding these concepts can shape your entire investment approach. First, let's talk about cash flow. Cash flow refers to the money you make every month after paying your property expenses, like mortgage, maintenance, and taxes. It's all about steady, immediate income, typically from rental properties. Next is appreciation. Appreciation is the increase in property value over time. Investors who focus on this strategy are playing the long game, buying properties they expect to sell at a much higher value in the future. So, which one is right for you? Over this series, we'll dive into each strategy to help you make an informed decision. In the next video, we'll take a closer look at cash flow properties and why they're popular among certain investors. Stay tuned. In this video, we're exploring cash flow properties. These are properties that generate rental income month after month, providing a steady stream of cash. Cash flow properties can be single-family homes, multi-family buildings, or even commercial spaces. The idea is simple. You collect more in rent than you spend on property costs. But location is key. High-rent areas with strong demand can boost your cash flow significantly. Think about cities with growing populations or near college campuses. Investors love cash flow because of its predictability. You get paid each month, which can be especially appealing if you're looking for short-term returns. But like any investment, there are risks. Things like property management, repairs, and market fluctuations can impact your income. In this video, we'll dive into appreciation. If you're in it for the long haul, this strategy might be for you. Appreciation refers to the increase in property value over time. Unlike cash flow, appreciation doesn't give you immediate returns. Instead, you're banking on the property's value growing over several years. Investors target areas where growth is likely. Places with booming economies, infrastructure development, or limited supply of housing. Think about tech hubs or coastal cities where demand is high. As the area grows, so does the value of your property. The key to success here? Patience. You'll need to hold on to your investment for years to see the payoff. But be aware, appreciation is tied to market cycles. If the market takes a downer, your property's value could stagnate or even decline. Rental demand is key. Let's talk about what makes a market boom. For appreciation to work, you need to be in an area that's growing fast, whether it's economic growth, job opportunities, or infrastructure development. Some key indicators of a booming market include population growth, new job sectors, and major projects like new transit lines or tech campuses. These signs often point to future property value increases. Examples of these booming markets include places like Austin, Texas, or Nashville, Tennessee, cities that have seen major appreciation in recent years due to economic expansion. Every investment has its pros and cons. So, let's take a closer look at the ups and downs of cash flow investments. The benefits of cash flow are obvious. Steady, predictable so it's not for investors who need immediate returns. Why choose between cash flow and appreciation when you can have both? Some properties and markets offer a combination of both strategies. Hybrid investments give you the best of both worlds. Rental income in the short term and property appreciation over time. It's all about finding the right balance for your goals. Areas with steady rental demand and growing infrastructure can offer both cash flow and appreciation, giving you a balanced investment portfolio. Let's bring this all to life with some real-world examples. First, let's look at a successful cash flow investor. Investor A bought properties in mid-sized cities with high rental demand. They focused on collecting monthly rent and have built a portfolio that provides steady income. Now, let's look at Investor B, who bought in an up-and-coming tech hub. Over time, their property value skyrocketed, and they cashed in after several years of holding. Now that we've covered cash flow and appreciation, how do you decide which strategy is right for you? Ask yourself these questions. Do you need immediate income, or are you willing to wait for long-term gains? What's your risk tolerance? How long can you hold on to an investment? For some, a balanced portfolio of both cash flow and appreciation properties might be the answer. There's no one-size-fits-all, but by understanding these strategies, you can align your investments with property management in the next video. Managing a cash flow property. And long-term goals. To grow your cash flow portfolio, financing is key. But what financing options are best for cash flow properties? In this video, we'll break down some of the most popular choices and how they impact your monthly income. First up, traditional mortgages. These are the most common for investors, with down payments ranging from 20 to 25%. The higher the down payment, the less you owe each month, resulting in more cash flow. However, you'll need to ensure the rent covers the mortgage and still leaves room for profit. For those who want to put down less money up front, FHA loans are a great option for owner-occupied multifamily properties, with down payments as low as 3.5%. You'll need to live in one of the units, but this allows you to start investing with less cash. Portfolio loans are ideal for investors with multiple properties, as these loans are tailored to your investment portfolio rather than individual properties. Private financing or hard money loans are another option for those looking to move quickly or finance properties that need renovation. Taxes can be a real burden for real estate investors, but with the right strategies, You can significantly reduce your tax liability and boost your cash flow. One of the best tools at your disposal is depreciation. Even though your property might appreciate in value, the IRS allows you to deduct the depreciation of your building as if it were losing value. This can provide substantial tax savings, increasing your net cash flow. Other deductions include property management fees, repairs, maintenance, insurance, and even travel expenses if you need to visit your property. It's important to track all of these expenses throughout the year. Another tax benefit is the 1031 exchange. This allows you to defer capital gains taxes when you sell a property, as long as you reinvest the proceeds into a similar or higher value property. This keeps more money in your pocket, giving you the ability to grow your portfolio faster. Always consult with a tax professional to ensure you're taking full advantage of these benefits. Once you have a couple of cash flow properties under your belt, the next step is to scale your portfolio. The more properties you own, the more rental income you can generate, but scaling requires a solid strategy. To scale successfully, you'll need to maintain a balance between acquiring new properties and managing existing ones. This means ensuring each property is generating positive cash flow before adding another one. Many investors use a strategy called the BRR method: buy, rehab, rent, refinance, and repeat. This allows you to pull cash out of one property and use it to fund the next. You'll also need a strong team in place: property managers, contractors, and a real estate agent to help you scale efficiently. As you grow, consider diversifying across different markets to reduce risk and maximize your cash flow potential. When it comes understand why diversification is essential, let's dive into how you can effectively diversify your real estate portfolio. Start by exploring the different property types available to you. Residential properties, such as single-family homes or multifamily units, are a great starting point due to their stability and demand. Commercial properties, like office buildings or retail spaces, can offer higher returns but require careful market analysis. Industrial properties, including warehouses and manufacturing plants, are another option, often benefiting from long-term leases and lower vacancy rates. Don't overlook raw land. It can be a strategic investment if you're looking at future development opportunities. Each property type serves a unique purpose in your portfolio. In addition to diversifying by property type, consider geographic diversification. Investing in properties across different regions or cities can protect you from localized market downturns. For instance, if the real estate market in one city slows down, your investments in another thriving area can help balance your overall returns. If managing multiple properties feels overwhelming, consider investing in real estate investment trusts, REITs, or real estate funds. These investment vehicles allow you to gain exposure to a diversified portfolio of properties without the need to manage them directly. It's a hands-off approach that still lets you reap the benefits of diversification. Diversifying your real estate portfolio doesn't have to be complicated. By exploring different property types, investing in various regions, and considering REITs, you can build a robust, balanced portfolio that stands the test of time. While diversification is a powerful strategy, It's important to avoid common pitfalls that can undermine your efforts. Let's explore the best practices in diversification to ensure you're on the right track. One of the biggest mistakes investors make is over-diversifying. While spreading your investments is important, spreading them too thin can dilute your returns and make it difficult to manage your portfolio effectively. Focus on a balanced approach. Choose a few property types and regions where you can gain a deep understanding and expertise rather than trying to invest in everything. The real estate market is constantly changing, and what works today might not work tomorrow. Successful diversification requires staying informed about market trends, economic indicators, and shifts in demand. Regularly review your portfolio and be willing to adapt your strategy as needed. For example, if you notice a particular region is starting to decline, consider reallocating your investments to a more promising area. While real estate is a valuable asset, it's also illiquid, meaning it can take time to sell a property. To avoid being stuck, ensure you maintain some level of liquidity in your portfolio. This could mean holding cash reserves or investing in more liquid real estate assets like REITs. Liquidity gives you the flexibility to act quickly when new opportunities arise or when you need to rebalance your portfolio. Diversification is a dynamic process that requires careful planning and ongoing management. By avoiding over-diversification, staying informed, and maintaining liquidity, you can navigate the complexities of real estate investing with confidence, ensuring your portfolio is strong, resilient, and profitable.
for the years to come. In real estate, an exit strategy is your roadmap for how and when to sell a property. It's one of the most important aspects of any investment because it directly impacts how much profit you'll walk away with. Whether you're a real estate investor, homeowner, or developer, an exit strategy helps you make informed decisions to avoid financial loss and maximize your returns. Let's break it down further. An exit strategy is essentially your plan for getting out of an investment when the timing is right. For example, you might be planning to sell after the property appreciates in value or after you've made improvements to boost its market price. Alternatively, you may have a long-term hold strategy where you plan to sell years down the line once you've built up equity or reached a specific financial goal. Either way, having a clear exit strategy in place means you're not leaving things to chance. It gives you a structured plan to follow, especially during unpredictable market conditions. For real estate investors, this is crucial. Many investors enter the market with the intention of either flipping properties for quick profit or holding onto them for passive income. If your strategy is to flip, your exit plan might involve selling as soon as you complete the renovations, ideally in a rising market. But if you're in it for the long haul, you might want to hold onto the property and sell later when the value has significantly appreciated or when market conditions favor sellers. For homeowners, having an exit strategy is equally important, even if you're not looking to sell right away. Life changes like job relocation, downsizing for retirement, or changes in family circumstances might push you to sell sooner than expected. Having a plan for when and how to sell ensures that you're prepared for these moments and can make decisions that protect your financial interests. For example, knowing the best time to sell in your local market can make a huge difference in how much profit you take away from the sale. Your exit strategy should also factor in market conditions. You want to avoid selling when the market is down, as this can lead to lower offers or a longer time on the market. Keeping an eye on trends and understanding real estate cycles will help you time your exit for maximum returns. If the market is hot and inventory is low, it might be the perfect time to list your property. But if the market is cooling off, you might consider holding on to it a bit longer or renting it out until conditions improve. Another key aspect to think about is financial flexibility. Let's say the property has appreciated significantly. Your exit strategy might involve selling and reinvesting the profits into another property or paying off debt. On the flip side, you might decide to refinance, pulling equity out of the property while holding on to it to continue earning rental income. Knowing your financial goals helps you choose the right exit plan. Ultimately, whether you're an investor or a homeowner, understanding your exit strategy from the very beginning ensures that you're not only prepared for future decisions, but that you have the best possible plan in place to make a successful and profitable exit when the time is right. Whether you're a seasoned real estate investor or just starting out, one key concept you can't afford to ignore is having a clear exit strategy. But why is this so crucial? Simply put, it defines how and when you'll leave an investment, locking in your profits or minimizing losses. Without a proper exit plan, you risk getting stuck in a property during a downturn or missing out on opportunities to maximize gains. An exit strategy helps investors make data-driven decisions. For example, if the market is hot, your strategy might involve selling quickly to capitalize on price growth. On the flip side, if the market is down, your exit plan might include holding the property until conditions improve, or even renting it out temporarily. Having a clear exit strategy also allows investors to better manage risk. Real estate is a long-term game, but external factors like rising interest rates, economic downturns, or local market changes can impact your property's value. A well-thought-out plan will guide you on whether to sell, refinance, or even reinvest your equity into a new project, giving you flexibility to adjust as the market evolves. Ultimately, an exit strategy gives you control over your investment. It allows you to be proactive rather than reactive, helping you achieve long-term financial goals with minimal surprises. Every successful investor knows the importance of planning the exit before even entering a deal. Market conditions play a huge role in determining how and when to sell your property. In real estate, timing is everything, and understanding market cycles can help you make smart decisions about your exit strategy. But what should you be looking for? First, pay attention to whether you're in a buyer's or seller's market. In a seller's market, demand for homes is high and inventory is low, meaning you'll likely receive multiple offers and can sell quickly, often for more than the asking price. In this case, your exit strategy might involve selling sooner to take advantage of the hot market. On the flip side, a buyer's market means there's more competition for sellers and homes might sit on the market longer. If you're in this situation, your exit strategy could include waiting until the market shifts back in your favor or renting the property until conditions improve. Keep in mind that holding onto a property during a downturn might come with additional costs, so make sure this aligns with your financial plan. Pay attention to interest rates as well. When rates are low, buyers are more eager to purchase, and this could be a prime time to sell. However, if rates are high, buyers may be hesitant to make offers, which could slow down your exit. Understanding these cycles and planning your exit strategy accordingly is key to maximizing your returns in any real estate investment. Timing the market is one of the most challenging yet critical factors in real estate. So, how do you know when is the best time to sell? There's no perfect formula, but several key indicators can guide your decision. First, look at seasonality. Spring and summer are traditionally the best times to sell, with buyers out in full force looking to move before the school year starts. Homes tend to sell faster and for more money during these seasons. However, if you're selling in the fall or winter, you may need to adjust your strategy to attract serious buyers and stay competitive. Another factor to consider is local market conditions. Keep an eye on real estate trends in your area. If home prices have been climbing consistently, it may be the right time to list your property and capitalize on rising values. Conversely, if prices have started to plateau or decline, you might need to decide whether to sell before they drop further or hold onto the property for the long term. Finally, keep your personal financial goals in mind. If you've reached your desired profit margin or if your property has appreciated significantly, it may be time to cash in and reinvest your gains into a new project. There are two common exit strategies for real estate investors: flipping and long-term holding. Each comes with its own set of pros and cons, and choosing the right one depends on your financial goals, risk tolerance, and market conditions. Flipping involves buying a property, renovating it, and selling it quickly for profit. The advantage of this strategy is that it allows for fast returns, often within a matter of months. However, flipping can be risky, especially if the market shifts during the renovation process or if unexpected costs arise. To make flipping work, you need a keen understanding of market trends and a reliable team to complete renovations on time and within budget. Long-term holding, on the other hand, is a more patient approach. With this strategy, you buy and hold the property for several years, collecting rental income while waiting for the property's value to appreciate. The benefits of long-term holding include steady cash flow, tax advantages, and the ability to ride out market downturns. However, it requires a commitment to property management and dealing with tenants. Both strategies can be profitable, but your choice should align with your financial goals and risk tolerance. When it comes to deciding how to exit a property investment, many investors find themselves choosing between selling the property or refinancing it. Both options have their benefits, but your choice depends on your financial goals and the state of the market. Selling your property means liquidating your asset and cashing out. If your property has appreciated significantly, or if you've met your financial goals, selling can provide you with a lump sum to reinvest elsewhere. However, selling also comes with transaction costs like agent fees and capital gains taxes, which will eat into your profits. Moreover, once you sell, you no longer benefit from the property's long-term appreciation or rental income. On the other hand, refinancing allows you to tap into your property's equity without having to sell. You can use the cash to pay off debt, renovate the property, or even invest in another property, all while maintaining ownership. Refinancing also allows you to benefit from lower interest rates, potentially reducing your monthly mortgage payments. However, refinancing may not be the best option if interest rates are high or if you're not planning to hold the property for the long term. Ultimately, the decision comes down to your financial goals. If you need immediate cash or want to exit the market entirely, selling might be the better option. If you're focused on long-term wealth building and want to keep your property in your portfolio, refinancing could be a smart move. A strong exit strategy doesn't just involve selling your property. It's about maximizing your profits and planning every step leading up to the sale. So, how do you ensure you get the most from your real estate investment? First, timing is everything. Understand the market cycles and make sure you're selling when demand is high and supply is low. This ensures you'll have more potential buyers competing for your property, which can drive up the price. Next, don't underestimate the power of curb appeal. A well-maintained property can sell for a premium. Before listing, invest in strategic upgrades like fresh paint, landscaping, or kitchen and bathroom improvements. Even small changes can add significant value to your property. Additionally, pricing your property right from the start is key. Overpricing may turn away buyers, while underpricing could leave money on the table. Work with a trusted real estate agent to set a competitive price based on comparable sales in your area. Lastly, consider staging your home to make it more appealing to buyers. A staged home can create an emotional connection and make it easier for buyers to envision themselves living there, which can lead to quicker offers at a high in your property. Continuous learning is key to staying ahead in any professional field. Books are one of the best ways to gain knowledge, improve skills, and expand your thinking. Reading not only keeps you informed about the latest developments in your industry, but it also opens up new perspectives and ideas. Whether you're diving into business strategy, leadership, or personal development, dedicating time to reading will give you a competitive edge. Remember, the most successful professionals are lifelong learners. They make it a habit to read regularly, staying curious and open to new ideas. So, pick up a book today, invest in your growth, and watch how it transforms both your career and personal life. Continuous learning is key to staying ahead in any professional field. Books are one of the best ways to gain knowledge, improve skills, and expand your thinking. Reading not only keeps you informed about the latest developments in your industry, but it also opens up new perspectives and ideas. Let's face it, the world is changing fast. New technologies, new methodologies, and new strategies emerge almost daily. By reading consistently, you stay at the forefront of these trends, allowing you to apply the latest knowledge to your work. Imagine the advantage you gain by diving into books about business strategy, leadership, or personal development. These resources can inspire new ways of thinking and even help you solve problems more creatively. It's like having access to the minds of experts from every field. Think about the professionals you admire most. Chances are they are lifelong learners, constantly seeking to improve themselves. Reading is not just a habit for them, it's a way of life. They stay curious, open to new ideas, and willing to challenge the status quo. So, if you're serious about staying ahead in your career, make reading a priority. Start by setting small goals. Read 10 pages a day, or tackle one new book a month. Over time, you'll notice how much more informed and confident you become. Pick up a book today. Invest in your growth, and watch how it transforms both your career and personal life. Knowledge is power, and the more you learn, the more empowered you'll be. In today's digital world, online courses have revolutionized how we learn. Whether you're looking to master a new skill, stay current with industry changes, or simply broaden your knowledge, online platforms offer endless opportunities. From expert-led classes to interactive lessons, these courses are designed for flexibility, allowing you to learn at your own pace, anytime, anywhere. You can dive deep into subjects like marketing, coding, design, and more, all while balancing your professional and personal commitments. The key is to select courses that align with your career goals. Prioritize quality over quantity. Choose courses that offer hands-on learning, real-world applications, and certifications that can boost your professional profile. So, explore the vast world of online learning. The right course could be the stepping stone to your next career breakthrough. Mentors play a crucial role identifying individuals whose values and achievements align with your goals. A great mentor is someone who's not just successful, but also someone who genuinely wants to help others grow. Seek mentors who challenge your thinking and push you out of your comfort zone. And life. Learning isn't limited to formal education or mentorship. It also happens through networking with peers. Building connections with people in your field can give you insights into different experiences, new ideas, and valuable feedback. Networking helps you stay in touch with industry trends and exposes you to opportunities you may not have discovered on your own. The key to successful networking is building authentic relationships. It's not just about collecting business cards or LinkedIn connections. It's about having meaningful conversations and finding ways to support each other's growth. Engage in discussions, attend events, and join professional communities. These interactions will not only sharpen your knowledge, but also expand your professional network, opening doors to potential collaborations and career growth. Remember, your peers can be an incredible source of learning and inspiration. Invest in these relationships, and the knowledge you gain will be invaluable. Lifelong learning isn't just a trend, it's a mindset that drives continuous personal and professional growth. In a world where industries are rapidly evolving, staying stagnant is no longer an option. Lifelong learners commit to expanding their knowledge throughout their lives, embracing curiosity and a passion for self-improvement. Whether through books, courses, mentorship, or real-world experiences, the key is to stay open to new ideas and consistently seek out opportunities to learn. Lifelong learning can help you adapt to changes, make better decisions, and stay competitive in your career. The most successful individuals understand that learning doesn't stop with a degree or certification. It's an ongoing journey. So, invest in yourself by making learning a habit. Dedicate time each week to exploring new topics, acquiring new skills, and reflecting on what you've learned. Remember, your commitment to growth today will set you up for success tomorrow. In today's fast-paced world, staying updated with industry trends is essential for remaining competitive. Every industry experiences rapid changes, whether it's due to new technologies, shifting consumer demands, or evolving regulations. The professionals who succeed are those who continuously adapt and evolve. Following industry news, attending webinars, and subscribing to relevant publications can keep you informed about the latest advancements in your field. Engage in conversations with peers and thought leaders to gain fresh insights and perspectives. Being aware of trends helps you anticipate what's coming next, allowing you to stay ahead of the curve. Whether it's new tools, methodologies, or emerging markets, staying informed ensures that you're always ready to seize new opportunities and navigate challenges effectively. Make it a habit to regularly invest time in learning about the latest trends in your industry. It's a powerful way to future-proof your career. Self-discipline is the foundation of consistent learning. It's easy to feel motivated at the beginning of a learning journey, but staying committed over the long term requires discipline and dedication. Setting clear goals and sticking to a regular learning schedule will help you stay on track. Whether it's reading, attending courses, or developing new skills, self-discipline ensures that you don't let distractions or procrastination get in the way of your progress. Remember, the small, consistent efforts you make today will compound into major achievements over time. Even when it feels challenging, pushing through and maintaining your discipline will lead to personal growth and success. Treat learning as a priority, just like any other important task in your life. By building the habit of discipline, you ensure that learning becomes a lifelong pursuit, empowering you to achieve your goals. Failure is often seen as something to avoid, but in reality, it's one of the most powerful teachers. Every mistake you make holds valuable lessons, if you're willing to learn from them. When things don't go as planned, take the time to reflect on what went wrong and why. These experiences can provide deep insights that help you improve and grow. Many of the most successful people have experienced major setbacks, but what sets them apart is their ability to learn from failure and come back stronger. Embrace your mistakes as part of the learning process. Each failure is an opportunity to refine your approach, adapt your strategy, and develop resilience. The ability to turn setbacks into stepping stones is what drives long-term success. So, don't be afraid to fail. Learn from your mistakes and use them as fuel for growth and progress. Setting clear learning goals A personalized learning plan is the key to making your learning journey both effective and enjoyable. Everyone has different goals, strengths, and ways of learning, so creating a plan tailored to your needs is essential for long-term success. Start by assessing your current skills and identifying areas you want to improve. Then, map out a learning path that includes books, courses, mentors, and hands-on practice. Break your plan into manageable steps and set specific timeframes for each goal. Your plan should be flexible, allowing you to adapt as your interests evolve or new opportunities arise. Regularly review your progress, celebrate your milestones, and make adjustments where needed. A personalized learning plan helps you stay focused, motivated, and aligned with your long-term goals. Take charge of your growth by building a plan that works for you, and watch how it transforms your personal and professional development. Now that you've learned the key strategies for continuous growth, it's time to put Tracking your spending for just 1 month can be a game changer for your finances. It's like shining a flashlight on your habits, revealing where your money really goes. You might be surprised to find that those daily coffee runs or subscription services add up quickly. By setting up a simple system, whether it's a notebook, an app, or a spreadsheet, you can categorize your expenses into needs and wants. At the end of the month, review your data. Look for patterns. Where are you overspending? This insight is key to making smart adjustments and setting achievable savings goals. Start today and take control of your financial future. Now that we understand the importance of tracking, let's set up a system. You can track your expenses manually with a notebook, use a spreadsheet, or rely on budgeting apps that automatically categorize your spending. The key is consistency. Make sure you track everything from your daily coffee to monthly bills. Once your system is in place, you'll begin to see patterns in how and where your money is going. After a month of tracking, it's time to analyze the data. Look at your spending patterns and categorize expenses into needs and wants. You might be surprised to see how much you spend on dining out or subscription services. This analysis will help you identify where adjustments can be made without sacrificing your quality of life. It's all about being more intentional with your money. Now that we understand the importance of tracking, let's set up a system. You can track your expenses manually with a notebook, use a spreadsheet, or rely on budgeting apps that automatically categorize your spending. The key is consistency. Make sure you track everything from your daily coffee to monthly bills. Once your system is in place, you'll begin to see patterns in how and where your money is going. After a month of tracking, it's time to analyze the data. Look at your spending patterns and categorize expenses into needs and wants. You might be surprised to see how much you spend on dining out or subscription services. This analysis will help you identify where adjustments can be made without sacrificing your quality of life. It's all about being more intentional with your money. With your spending patterns clear, it's time to make some adjustments. Look for areas where you can cut back without drastically changing your lifestyle. Small changes, like cooking at home more or cutting down on subscriptions, can add up over time. The key is making conscious choices about where your money goes, so you can start saving more effectively. Now that you've identified where you can cut back, it's time to set your savings goals. Whether it's building an emergency fund, saving for a vacation, or working towards a bigger financial goal, setting realistic targets is essential. Start small and gradually increase your goals as you make progress. This is a crucial step in taking control of your finances. Tracking your progress is just as important as setting your goals. At the end of each month, review your spending and savings to see how well you're sticking to your plan. If things aren't going as expected, don't worry. The key is to adjust your approach without giving up. Financial success is a long-term commitment. When you're ready to invest, you'll need to choose the right type of investment account. Common options include brokerage accounts, retirement accounts like IRAs or 401(k)s, and education savings accounts. Each account type has its own benefits, tax advantages, and rules. In this section, we'll discuss the differences between these accounts and how to choose the one that's best suited for your financial goals. To achieve lasting financial success, it's important to build healthy habits. This includes regularly tracking your spending, sticking to your budget, and avoiding impulse purchases. Habits like these help you stay on track and keep you moving towards your financial goals. When analyzing your expenses, it's important to distinguish between fixed and variable costs. Fixed expenses include things like rent or mortgage payments, which stay the same each month, while variable expenses, such as groceries or entertainment, can fluctuate. Knowing this helps you plan more effectively and find areas where you can reduce variable costs while still covering your essential fixed expenses. Discretionary spending refers to the non-essential expenses in your budget, things like dining out, hobbies, and entertainment. These can add up quickly, and identifying them can help you find opportunities to cut back. We'll explore some tips for reducing discretionary spending without sacrificing too much enjoyment, and how to prioritize the things that truly matter to you. Small, recurring expenses, like subscriptions or daily coffee purchases, may seem insignificant, but over time they can take a big bite out of your budget. It's easy to overlook these costs, but tracking them is crucial for a clear picture of your spending. We'll explore strategies for cutting down on these budget leaks and reallocating that money towards savings or more important goals. An emergency fund is essential for financial security. It acts as a safety net in case of unexpected expenses like medical bills, car repairs, or job loss. In this section, we'll go over how to start building your emergency fund, how much you should aim to save, and tips for maintaining it so that you're always prepared for the unexpected. Once you've established your budget, it's crucial to review and update it regularly. Life changes, and so do your financial needs. Whether it's an increase in income or an unexpected expense, keeping your budget flexible allows you to adapt and stay on track with your financial goals. We'll explore how often to review your budget and strategies for making adjustments when necessary. One of the easiest ways to grow your savings is by automating the process. Setting up automatic transfers to your savings account can help you stay consistent without needing to think about it. We'll discuss how to set up these systems and the importance of paying yourself first. Using high-interest savings accounts is a great way to make your money work harder for you. These accounts offer better returns than traditional savings accounts. We'll go over how to find the best options and maximize the interest on your savings. Investing can be a powerful way to grow your wealth over time. But before you start, it's essential to understand the basics. Investing means putting your money into assets like stocks, bonds, or real estate with the expectation that it will grow over time. The key is patience. Investing is about long-term growth, not quick wins. In this section, we'll cover the foundational concepts of investing, including how it works, common terms you should know, and the importance of diversification. Managing your money, it's important to reflect on your progress. Take time to assess what's working and where you might need to make changes. Whether your income changes or your priorities shift, staying flexible with your strategy is key to long-term financial health. Thank you for watching. Now that you've learned the basics of saving and investing, it's time to take action. Start building your financial future today by downloading our free resources link below. Subscribe for more expert tips. And don't forget to share your journey with us on social media. Together, we can reach our financial goals.